The Keiser Report. Time now to turn to Ian Williams, Chairman and CEO of Charteris Treasury Portfolio Managers. Ian, welcome back to the Keiser Report.
Thank you.
Okay, Ian, last time you were here, we were talking about silver. You had a bold prediction. You were looking for $150 on silver. It's up 6% already in 2013. What's the update?
Well, so far so good. I mean, it's doing roughly in a small way what we thought it might do. It's going up. It's pretty much almost gone up every day this year, and it's outperforming gold, which is something else we thought would happen. And we think there's a lot more potential in the move. I mean, the US Mint has had to stop selling silver coins.
Yeah, what do you make of that? There's apparently a shortage.
There's a
shortage is developing in the silver market. Is that correct?
That's right. There's just a massive demand for these silver coins, and they can't mint them fast enough. So.
And what's the annual supply of silver? Is not that great. That comes out of the ground, right? It's only about 700 million ounces.
Yeah, exactly. And unlike gold, one of the big differences between gold and silver is the central banks aren't sitting there with tons and tons of silver in their vaults. The central banks don't own any silver. They own loads of gold, but they don't own any silver. So there's not this immediacy of supply that can suddenly hit the market.
People are confused by silver because it's both a monetary metal, but it's also an industrial metal. It's used now in solar.
That's correct.
And of course, there's these huge solar arrays being constructed around the world, the use of silver. Now people are buying it as a monetary metal. And there's another interesting relationship I'd like to talk, for you to talk about it, between the price of silver versus gold in ounces, and there's a relationship there. Historically, it usually would be 16 ounces of silver to 1 ounce of gold. These days, it's more like 50 or 53 ounces of silver to gold. There's this huge gap. We'll talk about that.
First of all, on solar panels, it takes 2/3 of an ounce of silver for every solar panel that's made. And as the technology starts to get more advanced, solar power is potentially the big growth market in. See, a lot of the emerging world, it also lives in the hot countries. So countries like India, solar, the potential increase in solar panels in a country like India, which doesn't have a great national grid, but has lots of sunshine, is phenomenal. And then you look at all the Arab countries. I mean, it's all about price. It's all about how solar is priced relative to oil. But I mean, if you look at a country like Abu Dhabi, they've got huge amounts of unused land in the desert, got loads of money, but they got no water, so it's a no-brainer. At some stage they're just going to fill the desert up with solar panels and use the energy to convert seawater into fresh water. And so it's huge. Potential for solar is enormous, far more than on a global scale than something like wind farms or.
So desalination of seawater is also used with these solar array
Well, you use the energy, you use the electricity to then boil the water and effectively convert. See, at the moment, that's what they do, but they use oil to convert, which doesn't cost them anything because it comes out of the ground for virtually nothing. But at some stage, you can see a situation where all these vastly rich countries and growing countries all around the world, solar power is going to be a major answer to their energy shortfalls.
Let me ask you a question of something I saw out of China. I think you have maybe more insight into it, but there was a report last week that production of the Apple's 27-inch screen for their computer, which uses silver, they actually had to halt production because they couldn't source silver.
There's a real problem. I mean, it was like the same with the mint. This US mint can't get enough silver to churn out these coins, so they've had to temporarily halt sales of the coins. But I mean, all that's going to do is make people more interested in buying them. You know, if you hear something that there's massive demand for something, and they've had to temporarily suspend sales, it makes even more people interested in buying them. And you know, it's a poor man's gold. So they're opening up silver exchanges in the Far East, and in a much lower denomination amount of money. So it opens the audience who want to invest in precious metals to a much wider audience. A lot more Chinese citizens can buy silver coins than they can afford to buy a gold coin.
Now, a lot of people talk about manipulation in the silver industry and in the gold and gold markets. The COMEX,
mainly,
gold, but also silver. There's a huge investigation into this. And one thing I've noticed about the silver market, whether it's the COMEX or the LBMA, is that the quantity of sell orders that would knock the price of silver down $1 is 1/50th.
Yes.
The number of buy orders that it would take to move the price of silver up $1. Right. In other words, the way that the market is currently configured,
one big seller and lots of small buyers.
Right. There's a constant seller there, 50 times bigger than any buyer.
Yeah.
And of course, and some days they sell 100% of the annual production of silver in a single day from that seller.
Yeah.
So it's kind of a foolish investigation if these markets are being manipulated, because clearly, unequivocally, they are being manipulated with these huge sell orders that, for the most part, are naked short.
Yeah.
And a bank like J.P. Morgan, who is selling these naked short contracts, they've got enormous exposure to their balance sheet. At what point do the banks have to mark to market these enormous naked short positions? And is this going to lead to a markdown of these banks? And then from there, I want to get into their exposure to the bond market a little bit. But what are your thoughts on this?
Well, I used to work at Chase Manhattan Bank, which is now part of J.P. Morgan, and our desk, which was on the bond and foreign exchange desk, was right next door to the gold bullion desk. So we used to actually sit next to these guys, and we didn't see them taking any big positions. And a lot of what they did was customer driven. So if it is J.P. Morgan that goes into the futures market and sells, a big lump of silver, very often, or gold, very often they had a mining company or a customer that they were doing some financing deal with, and it was purely a hedge. And it's you can't, if you're a futures trader, sit in the pit and J.P. Morgan come in and sell a big lump of silver. You don't know whether that's for their proprietary desk, you don't know whether they're hedging some sort of loan agreement where they've lent the mining company some money and they've had to forward hedge out some production. You don't know what drives the deal. All you can see is them doing it. You have absolutely no idea behind what driving the transaction.
The industry, the mining industry, silver, gold mining, they have a need to hedge their output. To lock in prices and to get some predictability in their earnings stream.
Yeah, I mean, that's a variable item, but that's...
Yeah, but look at like American Barrick, big gold miner, for example.
Yeah.
They have gotten rid of all their hedges. They've canceled their hedges.
Yeah.
They're net buyers of gold in this market. And we've seen that in the last 3 or 4 years. So I understand what you're saying, that there's an industry need to be hedging, and you see this all the time. But the industry has been unwinding their hedges. And you also have a very unseemly relationship between J.P. Morgan, who's got a $90 trillion derivatives portfolio, and the Federal Reserve Bank and the Treasury. Yeah. So is there a customer, the Federal Reserve Bank and the Treasury? How much overlap is there?
Yeah, well, on the hedging and de-hedging, in the bull market, I mean, when the bull market in gold and silver started off in sort of at the turn of the century, most of the miners had big hedges on their books. And there was, as the price rose, of course, the shares of the miners that didn't have hedges massively outperformed the ones with hedges, because the ones with hedges weren't getting the full benefit of the rise in the gold price. So there's a huge shareholder pressure then on the likes of Barrick as a classic example to buy back all the hedges, which they've gradually been doing. But then these banks still insist that if you're a mining company and you want to borrow money, so again, the mining company wants to develop a mine or wants to do some capex, it needs some cash. If it goes to the bank won't, are very reluctant to lend money to mining companies without locking in hedging a percentage of the future production. So it's not that the mining companies want to hedge the production themselves. Very often it's the only way they can get the money. The other way is to issue more shares, which the existing shareholders then suffer dilution, and they don't particularly want that either. So very often, if everyone is convinced the price is going up, it's probably better to borrow money from the bank rather than issue shares, and the bank will nearly always insist that 30-40% of the production is hedged, because it's viewed as too risky a transaction for the bank, because the price, it goes all over the place, and they can't guarantee future repayment of their loan.
You mentioned mining. There's a lot of talk about what would you call peak gold or peak silver. How close are we to, I mean, seemingly like South Africa, the gold is really down to a trickle.
Oh, yeah, I mean, that peaked ages ago.
So what about silver and gold? How is it, have we hit peak gold, peak silver?
I mean, there's probably, I think, going back to your 17-to-1 ratio, there's a similar amount. There's like, I think, 16, 17 times more silver in the Earth's crust than there is gold. So if you look at the performance of the various mining companies, it seems that the silver miners have fewer problems in expanding and maintaining their production than the gold mining companies. A lot of the silver mining is based in Mexico, and there's a lot of silver left behind from when the Spanish first started mining it, when they invaded Mexico, and in a way that there's not much gold left behind in South Africa. Virtually all the easy gold in South Africa was ripped out years ago.
You mentioned Mexico. Also, with passage of NAFTA under Clinton, it allowed for North American miners, in Canada particularly, to go down to Mexico under the new treaty engagement and reopen mines, silver mines that have been dormant for years.
That's right.
And they're using modern technology and they're extracting silver. Okay, there's silver coming out of the ground, but 700 million ounces, but it's being bought up by the industry, and we're running out of silver ounces. So at what point do we have a silver shortage crisis? Because you're saying two things here. You're saying that supply is pretty ample, but you're also saying there are shortage and bottlenecks developing. Is it a distribution problem? Where at this point does it become, we see the evidence of that?
No, I think what will happen is that there is massive potential demand for silver, which is why we think the price will rise much higher. And as the price rises, the mining industry will respond to rising prices by starting to mine some of the surplus silver that still is still possible to mine in Mexico. Because as you rightly say, when the Spanish were mining silver, they could only dig out what was really easy because they didn't have access to all this modern technology. So there's still big lumps of silver there that the Spanish never bothered or couldn't get out, that the modern mining industry can get out. So, but they're only going to do that in response to the higher price. So the higher price comes first, and then the mining activity will follow.
So your target on silver is 150.
Yes.
And since you've been here, you don't see any reason to step away from that price target. Is pretty much fulfilling the chart you're looking for.
I mean, we only put this forecast out just before Christmas. It's already up 6% or 7% this year already. It's already outperforming virtually every asset on Earth at the time, and we see that continuing.
Okay, we have about 30 seconds left. I just wanted to touch briefly on what I call the bond-pocalypse.
Okay.
Gilt markets was in a 300-year high, started to back off.
Yes.
Is the UK bond market ready to correct?
Yes, big time.
Big time? Like how badly? Where are we going with this?
Well, I think it'll something. I mean, the last big major bear market in gilts and treasuries was in 1994, where they fell, long-dated bonds fell 25% in 6 weeks. And I think what you're going to see over the coming 2 or 3 years will make 1994 look like a vicar's tea party.
Right, and there's a rotation from bonds into stocks and bullion, precious metals.
Yeah, so but yeah, out of what will be deemed to be monetary assets, i.e. cash and bonds, which are the value of which is probably going to get inflated away, into what would be real assets, which would be equities mainly at the moment, blue chip equities, and then it will trickle down into commodities and into ultimately the biggest beneficiary we think will be mining shares.
Absolutely. All right, Ian Williams, we're out of time, but thanks so much again for being on the Keiser Report.
Okay, thank you.
All right, that's all the time we have for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Ian Williams of Charteris Treasury. If you'd like to contact us, please tweet us at Keiser Report, at facebook.com/Keiser Report. Until next time, Max Keiser saying bye, y'all.